Hey everyone, it is good to be back with you. I have always been pretty open about my financial journey, the good, the bad, and especially the ugly parts for years. I just stumbled through buying into every hot tip and chasing every flashy headline thinking I could get rich quick. It led to some pretty brutal losses. Honestly, the kind that make you question everything you thought you knew about money. But those experiences, as painful as they were, taught me some invaluable lessons. They forced me to slow down, to actually learn, and to completely change my approach to investing. So today, I want to talk about something really big. Something that I think is going to shape the financial world for years to come, and it is something that could seriously impact your money if you are not paying attention. I am talking about the kind of economic shifts that redistribute wealth in ways that are often invisible until it is too late. We have a new Federal Reserve Chairman, Kevin Walsh, and there is a lot of talk about his plans to deal with the massive $39 trillion U.S. debt. Many people think it is impossible to just make that kind of debt disappear, that the U.S. would never openly default. But if you understand a bit of U.S. economic history, you realize there are ways to quietly reduce debt without an outright default. It has happened before. Think back to the Roosevelt era during the Great Depression with a single executive order. They effectively wiped out 40% of U.S. debt. Even though the Supreme Court later ruled it unconstitutional, the debt was still gone. That was a classic example of a soft default, and it has not been the only time. So why am I bringing this up today? Because history has a funny way of repeating itself. Today, the U.S. is burdened with astronomical debt. Far exceeding its economic capacity, simply growing the economy or honestly paying it back is just not going to cut it. This is the biggest, most urgent problem facing Chairman Walsh, and it seems he has a plan. His new financial strategy, which has been brewing for a while, aims to eliminate this huge debt and also trigger a massive global wealth transfer over the next few decades. This super reshuffling will affect every single one of us, because many of his proposed policy changes will result in some people bearing the brunt of the U.S. debt, while others, those who understand the financial game, could potentially make significant gains for the next decade or so. So what exactly is Walsh planning? It is a playbook the U.S. used 70 years ago. Let us dive in. The timing of this new Fed chair taking office is incredibly sensitive. The U.S. government debt is already over $39 trillion, heading towards $40 trillion. What is truly alarming is not just the debt itself, but the accelerating interest payments. The U.S. now spends $1.2 trillion annually just on national debt interest. This makes debt interest the government's number one expense, surpassing defense, healthcare, social security, and infrastructure subsidies. And this interest spending continues to rise every year. In 2025, $9.2 trillion of U.S. debt will mature and need to be refinanced. What does that mean? It means the money that was borrowed at 1% or even lower interest rates is now maturing. When it is reborrowed, the interest rates are now 4% or 5%. It is like your monthly mortgage payment of $3,000 suddenly doubling or more starting next month. For the massive amount of maturing U.S. debt, the additional interest alone will be around $360 billion annually. That is over $40 million burning away every hour. In just 10 minutes of scrolling through videos, the new interest accrues over $7 million. This is just the additional interest. The compounding is incredibly fast. So now you can probably understand why former President Trump has been so insistent on the Fed lowering interest rates in recent years. Because if they do not, the government itself will not be able to cope. This is Kevin Walsh's primary and most crucial policy direction: lowering interest rates. Trump has always said that U.S. interest rates should be the lowest globally, and the reason is simple. The U.S. owes the most money, and lower interest rates mean less interest to pay back. The market initially expected the Fed to cut rates by 50 basis points this year, but Walsh's stance has always been clear. He wants to cut more. If it were not for the Middle East conflict pushing up oil prices, he had originally planned to cut at least 75 basis points this year last year. He even publicly criticized the Fed for being too slow to cut rates. He aims to bring rates back to a neutral level around 2.75 to 3%. This is a core policy of the new Fed chairman, because every percentage point decrease in interest rates saves the Treasury hundreds of billions in interest payments. For the U.S. government, this is a lifeline, but here is the problem. We all know that the biggest issue with cutting interest rates is that it tends to push up inflation, especially with rising oil prices. Inflation is already showing signs of increasing. It would be good if rates did not rise and you want to cut them. This is precisely why the Fed has been so hesitant to cut rates previously. So, what is the solution? Walsh is already under immense pressure. He wants to cut rates, but inflation is proving stubborn. Kevin Walsh has hinted at his approach to this major problem during his hearings. He believes this involves a shift in policy and policy execution, a new risk model where the risk lies with the federal government's choices. He suggests the Fed needs a completely new inflation framework and that policy making and the central bank's understanding of inflation need reevaluation. Currently, the Fed closely tracks PCE, personal consumption expenditures. These inflation metrics might also need to change. How exactly this will be done remains to be seen. He even said that rigidly setting the inflation target at 2% is asking for trouble. This implies he opposes the 2% inflation target and would allow for higher inflation. This would be a very significant change for the Fed. Are you starting to see the picture now? Walsh definitely wants to cut interest rates to reduce debt interest payments. On the other hand, regarding the inflation risk, he wants to redefine inflation and reject the rigid 2% target. He is paving the way for higher inflation. Behind this is a key framework, and it is the most discussed term among smart money on Wall Street today: financial repression. This is also the core of our discussion today. The US has used it multiple times in its history to resolve massive debt crises. Let us take a closer look at this grand debt repayment plan. What is financial repression? Simply put, it is when the Fed deliberately keeps interest rates below the inflation rate. For example, inflation is allowed to be 4%, but interest rates are kept at 2%. This creates a gap, so Walsh wants to lower interest rates on one hand and allow for higher inflation on the other. Otherwise, this method will not work. This has been the most effective and repeatedly successful method for the US to resolve huge debt problems throughout history. It is not about actually paying off the debt, but about financial repression. It was done this way before. In 1946, after World War II, US debt exploded, with the debt-to-GDP ratio reaching 106%. At the time, all economists believed the US would default within the next 40 years. Sounds familiar, right? But what happened? The US did not default. Not only did it not default, but by 1974, the debt-to-GDP ratio had fallen to about 23%, from 106 to 23% in just over 2 decades. How was this achieved? Was it due to rapid economic growth? Not at all. According to research by the Center for Economic Policy Research, historical experience shows that you should not expect to reduce debt solely through economic growth because it is simply not achievable. Instead, it relies on financial repression, on unexpected inflation. This is the most viable reality that has repeatedly occurred throughout history. According to their research, in the 76 years from the end of World War II in 1946 to 2022, economic growth alone could at best reduce the debt-to-GDP ratio from 106 to 84%. But in reality, after just over 2 decades, the US debt-to-GDP ratio had already dropped to 23%. This means that economic growth contributed at most about 20% to the reduction. The vast majority of the debt was systematically eroded by the government. This is the power of financial repression, but this inevitably comes at a huge cost to someone: those who were most conservative and diligently saved their money back then. From 1945 to 1980, for 35 consecutive years, wealth was quietly transferred to the government. Without realizing it, their hard-earned savings lost 80% of their purchasing power, making them the biggest victims. And most people did not even know why their money was buying less and less. Because this method is slow, subtle, and hard to detect. If you had saved $100,000 in 1946 and kept it until 1980-30, 5 years later, your real purchasing power would only be about $21,000. The government was secretly taxing without anyone's consent or notification. Money just became worth less. BlackRock, the world's largest asset management company, published a report in 2015 titled "The Past and Future of Financial Repression." The Federal Reserve Bank of Richmond has also conducted extensive research on this, and a well-known macroeconomist in London, Ricardo, published a paper titled "Financial Repression in the 21st Century." All of them discuss how it has miraculously helped the US eliminate massive debts in the past. This is actually the only historically proven method that can solve such immense debt problems without resorting to war or open default. So, governments are fully aware of what they are doing and deliberately choose this path. When you have an annual deficit of $2 trillion and a total debt of $39 trillion that continues to grow, there is simply no other way out. So, it is highly probable that the US will repeat history. Simply put, the US has no intention of genuinely paying back its debt. Not really. The only true plan is to transfer the debt elsewhere. They intend to slowly erode all debt using an increasingly devalued US dollar. Walsh also has a more overt plan to combat inflation using AI. He believes that AI will lead to a super productivity revolution. As businesses use AI to increase production efficiency, costs will decrease and goods will become cheaper. Therefore, even with interest rate cuts, severe inflation will not be triggered. For professionals like lawyers, accountants, and engineers, AI can enable them to do more in the same amount of time. A lawyer who used to handle 1 case per HR might now handle 10. This would reduce the cost of services and prices would fall. In the long run, AI might indeed lead to disinflation. However, the biggest problem is that this has not happened yet. Not today, not tomorrow, and possibly not even in the next year or two. The most immediate impact of AI is the frenzied construction of data centers, power plants, grids, and servers. This involves massive capital expenditures and investments. Many companies are still in the investment phase, which in the short term will actually drive up costs and inflationary pressure. This completely fails to support his rationale for wanting to cut interest rates today. I believe Kevin Walsh certainly knows this. While this assumption might hold true in the long run, it is not a quick fix for the current problem. So, he has a two-pronged approach. His logic might be this: If AI genuinely drives rapid economic growth, then the US might be able to gradually reduce its debt through economic development. But what if AI does not deliver as expected? Then the more reliable option is to quietly digest the debt through financial repression. This is why Walsh wants to reform the inflation framework. Why he is not stubbornly sticking to 2%? Because 2% inflation is too slow, the dollar is not depreciating fast enough, and the $39 trillion in debt is not shrinking quickly enough. As long as the dollar's depreciation rate consistently outpaces interest rates, eventually our debt should be eliminated. Whether AI succeeds or not, a slow, soft default through inflation is the most stable choice. He has actually hinted at his policy direction during his Senate hearings. So ultimately, who will pay for this massive plan in financial repression? There are always losers, because if one side's debt is reduced by 80%, then someone else has undoubtedly borne that 80% burden. Who bears it? Those who hold cash CDs and money market funds. Those who work diligently and save fiercely will, little by little, silently pay to save the entire system in the future. So, the biggest losers in the future will be savers, but investors will get richer. Historically, sometimes stocks perform best, sometimes real estate, sometimes gold, and sometimes Bitcoin. But the real key is that you cannot just hold cash, you must hold assets. In the 35 years after World War II, if you held physical assets, you would have become wealthier and wealthier because you held assets that outpaced inflation. The government was paying back debt with devalued dollars. While the government canceled debt, it also effectively canceled a portion of your mortgage. Your house remains yours and the banks lose out. Even with moderate inflation, the real burden of your mortgage will significantly shrink in 10 years. So, if you currently have a 30-year fixed-rate mortgage below 4%, you should be thrilled. Your mortgage itself is your best asset. If you own rental property, rents will also increase with inflation, and your income will grow while your monthly payments remain constant. The gap between what you earn and what you owe will increasingly favor you. In the 1990s, when inflation was low and interest rates were high, paying off your mortgage early made sense, but now if the Fed is actively working to inflate away $39 trillion in massive debt, then paying off low-interest mortgages or other debts early is like voluntarily giving back profits you already have. Because for the next few decades, the Fed is actively helping you devalue these debts. Note I am talking about low-interest loans here, so what we are most likely to see in the future is a worsening K-shaped economy. What does that mean? It means that those who own assets like stocks, real estate, gold, Bitcoin, and businesses will see their asset prices continue to rise. Those who only hold cash will be effectively taxed and find life increasingly difficult. In other words, the rich will get richer and the poor will get poorer. Currently, the top 10% of Americans already own over 90% of the assets. If we experience another 10 years of financial repression, this proportion will likely only expand. Of course, the market will not always go up. There will be recessions and crashes, but in the long term, asset prices will generally trend upwards. So I still believe that for ordinary people, it is necessary to convert a portion of their wages into assets. This way, when asset prices rise in the future, you can at least get a piece of the pie we need to start thinking. Now, the last round of financial repression lasted 35 years. How long will this one last? Many people in the next decade will wonder why life is getting harder, why their income never keeps up with the cost of living, and why their savings are never enough. But they will not know the reason. But today, if we understand what is happening, we will know. We can avoid becoming the unwitting recipient of the government's massive debt. It is certain that the U.S. has never truly intended to pay off its debt. Never. The real plan is only one: to transfer the debt